Good afternoon, everyone, and welcome to today's presentation on making the most of your Microsoft benefits package. This presentation is hosted by Milestone Financial Planning. It will be recorded and readily available on demand for those who want it. Milestone is a fee-only investment management and financial planning firm specializing in helping clients around the country minimize their taxes and reach their financial goals. Today's webinar will be presented by Kyle LaBelle. Kyle is an advisor and owner at Milestone Financial Planning. He specializes in working with busy professionals to navigate their complex financial situations. Kyle's clients often come to him because they're overwhelmed by their financial obligations and worry about overlooking critical details that may lead to costly mistakes. Kyle helps his clients gain confidence in managing their assets, income, company stock, and employee benefits so they have more time and bandwidth to focus on what's important to them. A little bit about myself. My name is Garrett Climo. I'm a planning associate here at Milestone Financial Planning, and I work alongside our team of advisors, supporting them in client service and plan development. I will be moderating today's webinar, so please feel free to leave questions in the Q&A section below as they may come up. And a few quick disclaimers before we get into today's presentation. You can download the slides using your camera app on this QR code that you see in the top right-hand corner. Nothing you hear today should be considered tax, financial, or investment advice. Do not make financial or investment decisions based on this or any other webinar. Instead, meet with a qualified financial advisor regarding your specific goals and financial circumstances before making major financial decisions. Note that almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Past performance of investments does not predict future results. And lastly, advisory services are only offered to clients or prospective clients where Milestone and its representatives are properly licensed or exempt from licensure.
All right, thank you for that introduction, Garrett. Without further ado, let's jump into today's presentation. For today's webinar, we'll cover a number of different aspects of a Microsoft employee's compensation and benefits package. We're going to start with an overview of the typical employee's compensation, including your salary, bonus, RSUs. We'll then move on to a deeper dive on your RSU awards and what you should keep in mind when managing them. Next, we'll walk through Microsoft's ESPP plan, their 401k, and the Mega Backdoor Roth strategy. We tend to get a lot of questions in this area, so we'll spend a bit more time here today. After that, we'll discuss Microsoft's deferred compensation plan, who it applies to, and what those individuals should consider when looking into using it. Finally, we'll spend the end of our session discussing Microsoft's insurance offerings and other perks and benefits. Before we can look at maxing out your comp, we need to understand the basic moving pieces available to you. The first piece is your salary. This aspect is pretty straightforward. It's the total amount of your regular pay broken up into 24 equal semi-monthly payments. Your salary gets taxed to you at ordinary income rates, and it's worth noting that your take-home pay is almost always going to be less than your gross salary. This is because things like taxes and benefits will be deducted from it to net out to what you actually take home at the end of the day. The next element is your annual bonus. This typically ranges anywhere from 0 to 40%, depending on your performance, position, and job title. It ends up getting paid out at the end of August each year. And something to note with your bonus is it's also taxed at ordinary income rates. There's a common misconception out there that bonus income gets taxed more than your regular pay. This isn't strictly true. Your bonus is added to the rest of your ordinary income, things like your salary and other items that are taxed ordinary income brackets, and applied to our progressive tax system. Instead, what some people perceive as higher taxation is the fact that your bonus has a certain amount withheld for tax purposes. This is known as the mandatory withholding amount. This is often a flat 22% for federal taxes, which may be more or less than what you need withheld to meet your tax obligations. This can cause you to get a significant refund or owe a significant amount of taxes when you file your return. So you want to plan around this when you're getting your bonus to ensure if you're in a higher tax bracket that you're adjusting your withholdings accordingly. The third piece of the compensation puzzle is your equity. For most Microsoft employees, this is going to include your RSUs and ESPP, though a small subset of employees will also have stock options. Since stock options are less common at Microsoft, we're not going to focus on them in today's discussion, but they are another layer of the potential compensation Microsoft provides. Finally, Microsoft offers a range of other benefits. These are things like your health insurance, the Perk Plus program, life and disability options, MetLife's legal plan, and for those 67 plus, your deferred compensation plan. So with that primer behind us, let's dig deeper into RSUs, what they are, key dates to keep in mind, how they're taxed, and important tax tips to consider when planning around them. To start off, RSUs, also known as restricted stock units, are a form of equity compensation. So rather than receiving cash, you're awarded money in the form of Microsoft stock. With RSUs, you're awarded a fixed number of Microsoft shares with your grant. These typically vest over a specific period of time, which is typically going to be quarterly over 5 years. And the actual value of the compensation you received changes based on how Microsoft stock performance does between the time that you're awarded the shares and they actually vest. Now, I often recommend people think of their RSUs like a bonus that you're receiving in cash rather than as stock itself. Like a bonus, but instead of getting it in cash, you're getting it in stock. This can help with mental accounting and the fact that if you wouldn't buy that stock with a cash bonus, you may not want to hold on to your RSUs after they vest. So some key information to track and keep in mind include your grant date, vesting schedule, and the number of shares granted to you. Fortunately, all of this information and more is outlined in each of your RSU award agreements. I highly recommend reviewing each of and every award agreement when you get it. There's a lot of great information in these documents, and it helps lay out what you're getting from Microsoft. So the vesting date is when you actually get access to each tranche of shares that you're being given. This is also when those shares are going to be taxable to you, and we'll discuss the taxation later on. On the other hand, your grant date is when Microsoft awards you your RSUs and your award agreement. So vesting is when you get access to them. The grant date is when you are actually granted them. Your vesting schedule outlines when each of your vest dates will occur. It also shows you how many shares of Microsoft stock you'll receive on that date. Finally, your shares granted are the total number of shares you'll receive as part of your award. So let's look at how your RSUs are going to be taxed. There's often a fair amount of confusion around this, so let's look at the two pieces that are involved. First off, there's no tax implications when you're awarded the shares. So again, this is when they're granted to you. There's no tax at that point. However, once your shares do vest, you have full access to them at that point, and they are then included in your taxable income. This means that they are taxed to you the same way your salary, your bonus, income interest, other types of ordinary income items are taxed, and you'll actually see it reflect on your pay stub that day as well. Now, the second component is when you actually sell the shares. The difference between the price at vest and the price when you sell the shares is going to be taxed to you at capital gain rates. Now, if you hold those shares for more than a year after they vest, you can get taxed at preferential long-term capital gain rates. Whereas if you hold it for less than a year, you're going to be taxed at higher short-term capital gain rates, which are the same as ordinary income. While selling shares within a year of vesting causes them to be taxed at higher rates, this may still be the best option, especially if selling soon after the shares means that the difference in price between when you sell and when they vested is pretty small. Then the tax component is going to be pretty small as well. So it's a way to kind of take taxes out of the picture with the rest of your RSUs. Now let's look at a few other important tax items related to your shares. First, when you do sell your RSUs, you'll want to make sure you get what's known as the supplemental information from the plan administrator and either utilize this yourself or provide it to your tax preparer. Otherwise, you may be misreporting what's known as your basis. This is going to be the value of the stock when it vests. If you misreport that basis on your tax return, then you could end up paying more taxes than you need to do. So a really great actionable tip coming out of this is to go back. If you haven't been looking at your supplemental information over the years as you've been selling your RSUs, then you might want to go and actually amend prior returns to see if you reported things correctly or not. If you didn't and you underreported your basis, this is a great way to get a little extra money back from the IRS. And who doesn't love that? So second, it's important to note that Microsoft typically sells to cover with your RSUs when they vest. Now, this means that they'll sell a portion of the shares, so you won't actually receive 100% of what your vesting shares are. Typically, you're going to get 78%, and the other 22% is going to go for federal taxes. If you live in a state that has state income taxes, they could sell for that as well. Now, that 22% is the mandatory withholding amount, but just like with your bonus, that may not be the optimal amount that you want withheld for tax purposes. If you're in the 32%, 35%, or higher tax brackets, then having only 22% withheld means that you'll probably have a really big tax bill come tax time. And you'll really just want to be aware of this and plan for it over time to make sure that you're not having underpayment penalties, interest, and the sort. Now, we work with Microsoft clients on this all year long. We get their pay stubs as their RSUs are vesting and make sure that that's reflected in their tax and financial planning for the year. So if nothing else, there isn't a big surprise at tax time. So let's look at some of the common type of RSUs awards at Microsoft. There are really four common types that we see most often: on hire awards, annual stock awards, spot awards, and M&A retention awards. So on hire, spot, and M&A retention awards tend to be slightly less common. On hire, as the name suggests, are received upon hire. So a lot of times these awards are going to be larger than some of your annual stock awards. Your spot award and M&A retention award could also be larger as well. The key takeaway, if you have these three, is that one, you want to make sure that you're tracking when these shares are vesting, because it could be different from the typical schedule of February, May, August, and November that we'll cover with annual stock awards. So make sure you're tracking this. The other thing is your income could be significantly higher during these years, and this could be a great time to implement tax deferral techniques that we'll talk about in a little while. Things like maxing out your traditional 401k, using Microsoft's deferred compensation plan if you have it available to you, or just other general tax deferral techniques like batching charitable donations and stuff like that. On the other hand, annual stock awards, as the name suggests, typically come out annually. These are going to be awarded in August, September, based off of your performance, based off of Microsoft's performance and merit. And so these are typically going to be smaller than some of the other awards, but you tend to get similar amounts year after year, assuming performance stays the same. The big thing with this is really tracking that the February, May, August, and November dates of when these shares are going to be vesting, and that whatever plan you plan to implement for your RSUs, you're going to do that during these periods of time. So with that in mind, what are some common ways to actually manage your RSUs? There are two big strategies that I like to think of. The first is a conveyor belt method, and the second is the vest and hold, aka the HODL method or hold on for dear life method. So let's look at the conveyor belt. This is where you get your RSUs each year, you wait for them to vest, and then you sell them right away or soon after, taking the final product off of that conveyor belt and giving yourself some income in exchange. This method allows you to do a couple of things. One, it helps you diversify your investments. Two, it can help reduce the amount of risk that's associated with one single company by having a lot of your money in that company, especially if it's where you work. And three, it allows you to take the RSUs, which is Microsoft stock. It's money that you're given, but it's not in cash. And you take that stock and you turn it into cash that can be used for other things, right? Maybe you're going to use this to invest in a diversified portfolio. Maybe it's going towards short-term saving goals, whether it's college funding, buying a house, buying a vacation house, whatever that might be. Or, and this is probably my favorite option for RSUs, is using those proceeds to take advantage of some of the other amazing benefits Microsoft offers. We'll cover some of these in a lot more detail later on, but things like the Mega Backdoor Roth, things like the deferred compensation plan, or just taking it and using it for goals that you need to. So that's the conveyor belt method. The other option is the vest and hold or the HODL approach. Remember, hold on for dear life. You're probably going to be doing that as Microsoft goes up and down along the way. This is where you keep your RSUs after they vest and hold them moving forward, really just hoping that the price keeps going up. Now, I tend to talk with a lot of Microsoft employees who, consciously or not, end up defaulting into the HODL method. They may not have a plan in place. They may think Microsoft's going to do great. And so they just get those RSUs. They don't do anything with them and they just grow and grow and grow, especially if you're getting those on hire annual awards and other type of awards coming in. This could become a significant part of your overall net worth, which may not be the best thing to have it tied to one company. While Microsoft's done great over the last 15 plus years or so, doesn't necessarily mean they're going to continue to do great. And your income is already associated with how Microsoft's doing, so you may not want to tie your financial assets to it as well. Now, you also don't get to utilize the RSUs for cash flow purposes, and it can be difficult to take advantage of all of the different benefits Microsoft has with just your base salary alone. Even if you're making $200,000 or $300,000 a year, it can be tough to maximize your 401k and the Mega Backdoor 401k, maximize your deferred compensation plan, and all the other benefits we'll talk about today. Now, utilizing your RSUs over time, turning those into cash instead of stock is a great way to take advantage of the money and the other benefits Microsoft has. So, those who might want to consider keeping their RSUs should be those who have a lot of confidence in how Microsoft's going to do relative to other companies. The more confidence you have in Microsoft, the more likely you may want to utilize this method. Or if you don't have a lot of vested RSUs already, then you could consider keeping some of those vested RSUs in the form of stock rather than turning them into cash.
And Kyle, just to jump in quick here, is there any key tax advantages or differences in choosing one of the methods over the other?
Yeah, great question, Garrett. So there's no huge benefits to one or the other. There's just slight differences. So as I mentioned with the conveyor belt method, you're more or less taking taxes out of the equation, right? If Microsoft stock is vesting at $450 a share, and then you turn around and sell it the next day or a couple days later, and it's around 452, 453, well, you're going to pay some tax on that difference, the $2 or $3 of gain, but it should be pretty minimal. Right? So you're kind of taking tax off the equation when you're utilizing the conveyor belt, at least as far as the RSU itself is concerned. Now, with the vest and hold or hodl approach, when you're using that, there's a lot more variability because you have more time, right? And so Microsoft stock can go up, it could go down, and so that's going to change the tax situation. It's also important to note that if you hold the shares for longer than 1 year, then you can be taxed at long-term capital gain rather than higher short-term capital gain rates. So if you've already held stock for, say, 10 months or 11 months at this point, it may make sense just to hold it the extra month or two to get more than a year before consider selling it. But other than that, there really aren't massive differences on the tax side. Great question. All right, so with that in mind, we'll cover our next component, which is the retirement vesting provision. And Garrett's going to go over this for us and why you should care about it.
Yeah, and one of the key benefits that Microsoft offers is their retirement vesting provision, which allows you to continue vesting in your RSUs after you terminate your employment with Microsoft. This is a great benefit, providing you with additional income beyond your working years. Without this provision, you would forfeit any unvested RSUs when you retire. There are some eligibility and vesting criteria and conditions. In terms of eligibility, you have to terminate your employment with Microsoft, and you must meet one of the following age requirements, either age 65 and above with a qualified retirement, or age 55 and above with 15 years of continuous uninterrupted Microsoft service. In terms of vesting, this only applies to stock awards granted more than 12 months before termination, and your RSU award agreement must explicitly allow retirement-based vesting. So, how can this benefit apply to you? This can be a difference maker when choosing when to retire. For example, deciding whether to retire earlier at age 62 or aiming for that age 65 mark where you hit that qualified retirement. Or if you're in between the ages of 55 and 65, seeing where you would hit that 15 years of continuous service requirement to qualify for the retirement vesting. It's also important to be aware of the RSUs as an extra source of taxable income for future years. More income is always a good thing to have, but you don't want to be caught off guard when it comes to tax planning. Another thing is that RSUs also count as earned income. One thing to note here is that in order to contribute to an IRA, you need earned income, either for a traditional or a Roth IRA. RSUs will satisfy this requirement, and it'll allow you to contribute to your retirement accounts while in retirement. There are a few other additional requirements outlined in your award agreement, which, as Kyle's mentioned before, is so important that you read this as soon as you get any sort of awards. But if you have any additional questions beyond this, please feel free to reach out to Kyle. With that covered, let's move into our next topic on Microsoft's employee stock purchase plan.
All right, thank you, Garrett, for that. As you can see, the retirement vesting provision is a great feature for those it applies to. It can be a way to continue getting benefits from Microsoft even after you left the company. Also, something to keep in mind is it's not typical. A lot of corporations don't have this in their RSU award agreements, so it is an added benefit that you are getting as part of your compensation package, and just being aware of it is the main point here. So out of all of the things we'll cover today, I probably get the most questions around our next topic, which is Microsoft's ESPP plan. An ESPP, or Employee Stock Purchase Plan, allows you to buy company stock utilizing payroll deductions. This means a portion of your paycheck that would be coming in cash is being diverted to buy shares of Microsoft. The benefit of an ESPP is that you can often purchase these shares at a discount to the current price. For a qualified plan, which is what we'll focus on today because that's what Microsoft offers, the maximum discount is 15%, though Microsoft only offers a 10% discount. Now, while you contribute to an ESPP each pay period, again through those payroll deductions, you actually purchase the shares on a set schedule based on the plan's offering period. Now, when it comes to an ESPP, the question is whether or not it makes sense to use your limited resources to purchase company stock or use them for other purposes, right? Are you going to be using them for the Mega Backdoor? Are you going to be using them for cash flow, for short-term goals? That's really the question is it worth it? And so let's look at Microsoft's plan in a little bit more detail before we get to answer that. So with the basics under our belts, let's look at how Microsoft operates. As I mentioned, we get a lot of questions in this area and whether it makes sense for your situation. So let's see when it does and when it doesn't. But before we do, let's look at how Microsoft plan works. I mentioned that they offer a 10% discount to fair market value at the end of the period. So this means that when you're putting money in, after that period ends, see these offering periods below, at the end of that period, you're going to be able to buy the shares at 10% less of whatever the price was on that date. Now, this discount is great, but it is taxed to you as ordinary income. So that's something that you'll want to keep in mind. You'll want to keep it in mind for tax planning purposes. Now, it's worth noting that even though you do get that discount and that it's a good benefit, there's only so much that the IRS is letting you put into these plans because they're giving you that discount. And this is actually kind of a good thing in a way, because it means that if you have a limited amount of resources and you're limited to how much you can put in the ESPP, it could make sense to put some money in here, get some of that benefit if you have excess cash flow above and beyond what you need. So the IRS says that the limit on how much you can put into an ESPP is the lesser of 15% of your salary or $25,000, right? So in the grand scheme of an overall compensation package at Microsoft, this isn't that big of a number. And so it can be easier to fund it, at least to some extent, than some of the other strategies we'll look at later on. Now, as I mentioned in the last slide, you contribute to your ESPP each pay period, but only buy the stock at the end of the offering period. This means you're locking up some of that money for several months, which is reducing your flexibility and your ability to actually use it for cash flow and other purposes. And so in determining whether an ESPP is right for you, you need to take this inflexibility into account, right? Is that 10% discount enough to warrant giving up that flexibility? I like to think of it almost like a little CD. You're going to be putting this money in for a fixed period of time, and then afterwards you can get it out, right? And so it's up to you whether you think that's right for your situation or not. So who should use the ESPP plan? Well, it comes down to whether you have, one, the cash flow to do it, right? While 25,000 may not be as large as some of the other strategies we'll talk about, that's still a lot of money to fully maximize out this strategy. And if you don't have the cash flow to put the money in there, then you might want to look at another thing to use, or this could be a great opportunity to, again, sell those RSUs using that conveyor belt method, taking the proceeds, turning it into cash, and using that cash to live on while you're putting money from your paycheck into these other strategies. This is going to come up over and over again. It's a big reason why I do like that conveyor belt method. It's also an option for someone who is okay giving up some flexibility for a short period of time, knowing that they can turn around and sell the stock 3 months later at that 10% discount. Again, remember that discount is going to be taxable to you, so you'll want to account for that in your planning purposes, but it could be a good option if you have the flexibility to lock it up for a couple months. Now, it's probably not for someone who has a lot of cash flow needs during that period, who doesn't have the extra RSUs coming in and really needs most of their paycheck just to cover their basic living expenses. So with that behind us, we've covered Microsoft's equity compensation, and we're going to turn to one of the next benefits, which is their 401k plan. Here, we're going to talk about the 401k in general, but more specifically, we're going to talk about the Mega Backdoor Roth strategy within the 401k plan because we get a ton of questions there, and it's a fantastic benefit. Overall, Microsoft actually offers a very competitive 401k plan. You're allowed to put in up to $23,500 into a 401k utilizing employee deferrals. This is an IRS set limit. And I really want you to remember that limit and the name employee deferrals. We'll come back to that when we get to the Mega Backdoor. And this can be either in the form of pre-tax contributions or Roth contributions. So Microsoft does allow you to choose between those two. That's pretty common these days, but it is something that Microsoft allows. What's less common is the match that they provide, which is 50% of every dollar that you put in up to that $23,500 limit. This can be an extra $11,750 of compensation that Microsoft is giving you on your behalf in the form of your 401k. That's a great benefit to take advantage of right there. Something else that's nice about their plan is that match. It's 100% vested as soon as the money goes in. If it goes in and you leave a month later, you're not losing any of that match, even if you just started with the company. A lot of other corporations have a period of time where you have to stay employed in order to get that match. It's not the case at Microsoft. You do get those benefits right away. They also allow you to do catch-up contributions if you're over 50 and if you're between 60 and 63. But one of the biggest benefits is that Mega Backdoor Roth strategy. So this is a relatively new planning opportunity that's gaining in popularity. And as I mentioned, it is a fantastic benefit and one of the best ways for a Microsoft employee to really maximize their compensation package. Now, at its most basic level, the Mega Backdoor is a way for you to stuff a lot more money into your 401k and really your Roth 401k in particular than you'd otherwise be able to do. It allows you to use extra cash flow, whether it's from your salary, bonus, or those RSUs, and build your tax-free bucket and build up that 401k retirement account far more than you'd otherwise be able to do if you were just using that employee deferral limit. It's more tax efficient to be putting your investments into this Mega Backdoor than it would be if you were putting it in, say, a savings account, a brokerage account, or something like that. So you get to help on your overall tax efficiency of your plan. And again, who wants to pay more taxes than they have to? Utilizing this strategy is a great way to put your resources to the best use possible. Now, it is worth noting that this is really for long-term goals. It really is a retirement planning technique because it can be tough to get money out of the Mega Backdoor before you hit 55 or 59 and a half without penalties, interest, and stuff like that coming into play. And we really don't want that because that's going to take away some of the benefits here. So for those who are potentially needing this money sooner than 55 or 59 and a half, you may not want to be putting it all into the Mega Backdoor. So let's look at how this works in a little bit more detail. So the Mega Backdoor allows you to put a lot more into your 401k than you typically can. The reason being is, as I mentioned on the last slide, the IRS sets a limit to how much you can typically put into a 401k using your employee deferral. That limit is going to be $23,500 this year, and that's the most that you can defer into one of these plans. However, the beauty of the Mega Backdoor Roth is you can put much more into the 401k by making after-tax contributions. This is because there's a second limit that fewer people are aware of, which is known as the annual additions limit. That limit, instead of being $23,500, is going to be $70,000 this year. Now, it does include all money that's going into your 401k plan. It's going to include your employee deferrals, right? That's again a max of $23,500. It's going to include Microsoft's matching donations or contributions to the plan, which, if you're maxing out the deferral, is going to be $11,750. So total, this is going to allow you to put in $34,750 of additional money using these after-tax contributions. That gets to grow and move over into that Roth bucket and grow tax-free moving forward. This is a great way to turbocharge those retirement savings. Right. Any questions on that, Garrett?
Yeah, so if given that it takes a total of 58,750 to max out the Mega Backdoor Roth, for the average employee at Microsoft whose salary is about $200,000 a year, what are some techniques that you use to fully fund this strategy?
Yeah, good question. So again, it goes back to using your RSUs. It's a great way to free up the cash flow to be able to actually implement this strategy, right? It can be really tough for someone who's making 200 grand a year or even $300,000 a year at Microsoft to have the disposable cash flow to put 50+ thousand dollars into their 401k. But by taking those RSUs and selling them as they vest, it's a lot more feasible to implement this strategy. All right. And so let's cover who it's for and who it's not for. So the Mega Backdoor, as I mentioned, is for someone who wants to put more money into their retirement account bucket. It's not for someone who's looking to use this money in the next few years, unless if you're already close to retirement age. It's going to be for someone who's already maxing out their pre-tax or Roth 401k contributions through the elective deferral. The big reason here is if you're not already doing that, if you're not already hitting that $23,500, you're probably not going to be putting more money in. So you want to hit that elective deferral max first, and then start thinking about the additional after-tax contributions. And a good thing to point out is those after-tax contributions are getting immediately converted over to Roth. You do have to call Fidelity to make sure that's set up. So you want to make sure that you have daily in-plan conversions automatically set up with those after-tax contributions, so that otherwise the strategy doesn't work as well. But once it's set up that way, you're good to go moving forward. It's for someone who has either the salary and cash flow to do this, or has the ability to sell their RSUs as they vest to supplement their paycheck and use their paycheck to make these contributions. Because that's something to keep in mind, is this is going to come out of that salary. It's not going to be coming out of your RSUs themselves. Your RSUs would be used as a funding mechanism for you for the next quarter as your salary is going into implementing this strategy. And so who this isn't for, again, if you have short-term cash flow needs, it's probably not best for you because it's going to lock up that money. If you're not maxing out those accounts already, probably not worth it, because to get to the full limit, it's going to take a lot more than what you're already putting in as the 23,500. But if you can cover that, then it could be a good option. And if you want more flexibility to use that money before retirement, if that's the case, then I highly recommend using a taxable brokerage account over the Mega Backdoor strategy, since that's a lot more flexible.
Kyle, just to jump in real quick, we got a good question from the chat, and it says, does the backdoor contribution include HSA contributions?
Good question. So it doesn't. This is only going to be contributions to your 401k in total, right? So that's going to be up to that limit. That annual additions limit is what we're looking at. The IRS has these different buckets, right? Your 401k is going to be in one bucket, HSA is going to be another, IRAs are going to be in a third. And so we're really looking at that annual additions to a 401k, 403b account, rather than everything lumped together. So in theory, you can put in the max into your 401k, and then you can also max out your HSA. This year, I think it's 4,300 for a single person and like 8,550 for a married couple. So you can do both. It's not one or the other. Any other questions, Garrett?
That's all. Thank you.
All right. So next up, we'll look at the Microsoft Deferred Compensation Plan. This is less common as an option, but it can be extremely helpful for those who have it. It's only available to level 67 plus employees, and it allows you to defer additional income. Now, remember when we were talking about annual awards and the different types of RSU awards? If you were getting large on-hire, M&A retention, annual awards, or spot awards, you could have been having a lot higher income in those years. Well, if you're a level 67 plus employee, you're probably making over $300,000 at Microsoft, getting significant RSUs. And this strategy is a way to reduce your income this year, defer those taxes until the future, and then take the money out like a retirement account, typically at 65 or older. Now, the Microsoft Deferred Comp Plan allows you to defer up to 75% of your salary and or up to 100% of your bonus. These are two separate things, and you make the elections at different points in time, but either or both could be a good option for you. And then you get to choose later on when that money is going to actually start coming out of the account. You make that election now, but you typically have the opportunity to adjust that election at some point in the future. But usually it'll be at retirement or at an age like 65 or something like that, when your hopefully income and tax bracket's going to be lower than it is now. So is the deferred comp plan a good fit for you? Well, for those who have it, it's probably worth looking into and considering using. You'd really want to look at your individual tax and financial situation to truly tell whether it makes sense or not, because you are deferring taxes, right? You're deferring income and therefore deferring taxes. If you're in a high tax bracket now and you're going to be in a lower tax bracket later, then you want to defer that income, right? You'd rather get taxed at 10, 12% than 32, 35%. You'll end up saving money. But on the other hand, if you're going to get that money taken out later on at a higher rate, whether your overall tax situation will increase, or if you think that the government will increase tax rates because of funding problems or anything like that, then this might not be a good idea for you. It's also not a good idea if you need access to those funds in the next handful of years, right? Because you're choosing to defer the income until a set date. It's kind of like the mega backdoor strategy, where if you need immediate access to funds, you probably don't want to defer it because you're not going to have that cash flow. Again, this is where selling your RSUs as they vest can come into play, because you could potentially live off of just your RSU vests and a quarter of your salary and defer everything else until after your RSUs stop coming in. It's also not ideal if you're going to have a lot of big expenses and don't have the cash flow to cover it. And finally, this is something that is worth keeping in mind, is that while this money is being set aside for you, you get to invest the money. It's not guaranteed that you'll actually be able to get it back. So unlike a 401k plan where you're putting money into it, it's being protected by what's known as ERISA. 401ks are protected by ERISA, and so it's set aside in your name. A deferred compensation plan typically isn't. And the IRS says, okay, you can get access to this strategy, you can get access to the ability to push income into the future if there's a chance that you can lose access to that money. And so with the deferred comp plan, they tend to be available to creditors of the company, right? So if Microsoft were to go bankrupt, then the money that's in this deferred comp plan could be attached by the creditors and you may never actually receive that income. I think it's pretty unlikely that's going to happen given the size of Microsoft, but it is a viable possibility.
Kyle, we got another question quick on the backdoor. So if you sell the RSUs when they vest, pay the taxes, and use those RSUs to fund the backdoor, how are the investments in the backdoor taxed?
Good question. So the investments within the backdoor themselves are going to be tax-free, right? So when you're using the mega backdoor strategy, you're putting money in after tax. So this is money that you've already paid tax on, hence the after tax part of it. And then with that in-plan conversion, that daily in-plan conversion that I mentioned, it's automatically getting moved over into your Roth bucket, and Roth assets grow tax deferred and can be pulled out tax-free so long as you're over 55, 59 and a half, and you meet those criterias, right? So all of that money is going to get grow tax-free. Now the taxes on the RSUs themselves, you're still going to owe the taxes on those RSUs, right? So as we talked about, when the RSUs vest, that's going to be ordinary income and that's going to be taxed at that time. Then when you sell the shares, you'll have to deal with the taxes of the short-term or long-term capital gains, depending on how long you had them. But you can't really get around that part. It just, you sell them, you turn them into cash, and it would be the same as if you had, let's say, like $50,000, $100,000 in a bank account, and you lived off of that bank account and just used your paycheck to make this strategy instead. All right. Any other questions so far, Garrett?
That's all. Great. Thank you very much.
So now that we've covered the deferred comp plan, we're going to start moving on to some more common, but not as beneficial benefits, I guess. The first one of which is going to be health insurance. While health insurance is a huge benefit, Microsoft's plan is even better than a lot of other employer-sponsored health insurance plans that are out there. The first reason being is Microsoft covers the premiums for employees, right? So you're not having to pay each pay period most of the time to get health insurance through the company. Also, they have some really great plan options that we'll look at in a little bit more detail. So when it comes to insurance, there's kind of four big pieces that are worth paying attention to. First is how much are your premiums? Second is how much is your deductible? Third is going to be what is your co-insurance, co-payment amounts. And then finally is going to be your out-of-pocket maximum. Now, these are all elements from a financial perspective. Obviously, you're going to want to make sure that your health insurance is covering your providers, whatever treatments you need, all of that. So we're going to look at this mostly from a financial perspective with the caveat that you do want to make sure your providers and everything else is covered. So with that in mind, right, there are three plan types. The first is the health savings plan, the Kaiser HMO, and the Surest Health Plan. Now, I typically recommend most employees actually enroll in the health savings plan.
Now, Kyle, just looking at this chart at a quick glance, the health savings plan is the only one that has a deductible. Why is that generally the best plan for most employees?
Yeah, good question, Garrett. So as I was mentioning, there's kind of four moving pieces when it comes to insurance. There's the premium, which fortunately we don't have to worry about with Microsoft because Microsoft covers it. There's the deductible. Now, this is what you're going to pay out of pocket before your insurance kicks in. There's the co-insurance. This is going to be your percentage of medical costs that you're going to start paying. So for, let's say, the health savings plan, the maximum co-insurance is going to be $1,000. And then there's the out-of-pocket maximum. So the out-of-pocket maximum is really the big number that you want to look at when it comes to health insurance, because this is the most you'll have to pay for qualified coverage. So with that in mind, we can see that the health savings plan has the same out-of-pocket maximum as the Surest, and it's higher than the Kaiser plan, and it has that deductible. So why would we want to use the health savings plan? Well, if we look at the last column here, we can see that a big reason is Microsoft actually gives you money in an HSA, which can be used to help cover that deductible, right? So if you're level 30 to 39 or 50 to 58, Microsoft's going to give you enough towards your HSA each year to cover your deductible. So you could use that contribution to meet any of those costs that you're going to have to meet. Now, if we take that out of account, right, the most you're going to end up paying in health insurance if you're on that health savings plan is going to be that co-insurance. So maximum of what you might have to expect to pay in health insurance is going to be $1,000 if you factor the HSA contribution into it. Now, I'd be remiss if I didn't talk about the HSA in a little bit more detail when it comes to health insurance. And we did have a question around HSA contributions, which is great. So I do recommend utilizing HSA and HSA eligible plans as much as people can. And that's because HSAs are what are known as triple tax advantage accounts. These are accounts where when you put money in, anything that you put in, so this isn't going to be what Microsoft contributes, but anything that you put into the plan actually reduces your taxable income this year. That means you're going to reduce your taxes that year. Now, the money is going to grow tax deferred within the account. That means you're not going to pay any taxes on interest, dividends, capital gains, anything you're doing in the account from year to year. And finally, you actually get to take the money out tax-free as long as it's for a qualified medical expense, right? And so while you could use the HSA contribution Microsoft's giving you to cover your deductible, to cover any of those healthcare costs that you might have in a given year, what I typically recommend doing is taking it, investing it, because Microsoft allows you to use your HSA as an investment account, and then saving that money up later on. So in retirement, when you're almost certainly going to have more than $1,000 a year maximum of health insurance costs, you have this stealth retirement healthcare bucket, right? And so I usually recommend use the HSA, put as much into it as you can, invest it and save it until you need it at 65, 70, or potentially using it as a long-term care solution later in life. These really are fantastic vehicles, and I would probably prioritize saving in your HSA over just about anything else. Now, you could have an argument that it's worth the 401k first because you're going to get that match from Microsoft. So those are kind of neck and neck with one another. But after that, I would recommend the HSA over the Mega Backdoor, over the deferred comp plan, because you're getting triple tax advantages. Whereas with the other two, you're getting either single or double tax advantages. So I recommend most employees go on the health savings plan. It's typically the best choice. Just make sure that your providers are included within it and that you don't have any weird treatments or things that might be covered under one of the other plans, because they're also solid options as well, but they're not HSA eligible. All right, so with that in mind, let's look at two other insurance options that Microsoft provide. The first is going to be life insurance. Microsoft gives you up to 3 times your salary in life insurance. They pay for this for you. Something to keep in mind is that the value of it over $50,000 is going to be taxable income to you. You'll see this on your paycheck. It's usually coded as GTLI, group term life imputed income, something along those lines. And so you'll see a little line item on your pay stub. But this is an added benefit to you. It's nothing you have to do to get that 3 extra salary. Now, during open enrollment, which is right around the corner, you can increase coverage to up to 10x your salary or a maximum of $4 million. While you can do that, it's typically not the route I recommend people go. If you need additional life insurance above and beyond whatever you're getting through that basic 3 extra salary, I usually say, hey, go get a private plan. And the big reason is if you get it through Microsoft up to that 4 million limit and you terminate service from Microsoft, well, guess what? Your life insurance is going to terminate with you. You typically cannot take this with you when you leave. And so you don't necessarily want that, right? If you have that life insurance need, then you want to make sure that that's covered as long as you have that need. So I say keep the 3 extra salary amount, but then if you need extra above and beyond that, go and get a policy from a private provider. And we'll look at disability insurance pretty quickly. This is also covered by Microsoft. They pay for it for you. So it's nothing that you really have to worry too much about. There's short-term and long-term. Long-term is the more important of the two. For those who have an adequate emergency fund, that kind of functions as like a short-term buffer, whereas the short-term disability can be really helpful to supplement income, so you don't have to tap into your emergency fund. Short-term disability typically lapses after 3 or 6 months. And that's where long-term disability comes into play. This can give you income replacement from the time that your disability starts until either it ends or you turn 65. So this could be potentially decades of coverage coming from Microsoft to help cover you if you do get disabled. Now, one thing to keep in mind is that there is a cap on how much you're going to actually get out of your long-term disability insurance package, and it's going to be 60% of your salary up to a cap of $15,000 a year. So if you're earning more than $300,000 a year, including your RSUs, then you may not be getting enough long-term disability covered through Microsoft. Now, this isn't something you have to pay for, so you wouldn't change anything that Microsoft's offering, but you might want to go out and look for an additional policy, kind of like we talked about with term insurance, on the private market, something that's going to cover whatever you do need to live on if you do get disabled. And a lot of people tend to not cover enough from a disability perspective, right? Most people understand the importance of having life insurance, but it's typically more likely for someone under the age of 65 to have a disability event than it is to pass away. So having adequate long-term disability coverage is super important. Now let's look at Microsoft's legal plan. This is something that I see a lot of people opt into, and it can be really useful. It's something that you can use, your spouse can use, or a domestic partner for that matter, or your dependents. And it covers 100% of in-network attorney fees, with common services including wills and estate planning, real estate transactions, family and divorce matters, identity theft issues, right? So why might you want to utilize this? Well, if you haven't gotten that estate plan that you probably should have gotten by now and or updated, if that estate plan's 10, 15, 20, 30 years old at this point, you could enroll in the Microsoft legal plan, use one of their covered attorneys, and go and get those documents updated. And all you'd have to pay is the cost of the benefit itself. Also, if you are looking to buy a house, sell a house, or other real estate transactions in a year, well, this could be a good time to, again, utilize a Microsoft legal plan. If you're paying for the benefit, use it for whatever is necessary. And finally, if you are already in the plan, that's probably a good opportunity to accelerate any legal things you might need to get done. If you're paying for this benefit, you're already paying for it. If you've been paying for it, go and use it. It's added compensation that you can take advantage of, and it could save you thousands of dollars in these different services if necessary. And finally, we're going to cover Microsoft's Perks Plus program. So Microsoft offers up to an additional $1,500 per year in additional perks and benefits. Now, it is important to consider that anything that you utilize within the Perks Plus program is going to be added to your income. It's going to show up on your pay stub. You'll see a line item there, and it's going to be taxable to you. So just keep that in mind. It's not the worst thing in the world, right? Because even if you're in the top tax bracket, you're paying 37% in taxes, you're still keeping 63%. 63% of something's better than 100% of nothing, right? So it's a benefit that's available to you. Make sure you use it. Some of the options that you can use it for: financial wellness workshops, gym memberships, financial advising and consulting services, tax prep fees, well-being coaching classes, and there's a slew of other options within the Perks Plus program. If you're not already maxing out this benefit, it's a great way to add a little extra value to your overall compensation package. Because remember, Microsoft's giving it to you. You might as well take advantage of whatever they're going to give you. If you don't, they're just going to keep it in their pocket instead of it going into yours. So why do your benefits matter? Well, by maximizing your benefits, it means that you get to take home and utilize more of your overall compensation, right? If you get to take advantage of some of these things Microsoft's providing you, then you get more for you, your life, your family, and to live the way that you would like to live. It's a great way to turbocharge your retirement savings. It's a great way to help propel you towards your life and financial goals. The engine of your financial life is your job. Right? For most working professionals, your job is what's getting you to where you want to go. And if you're not taking advantage of the benefits that Microsoft offers, you're just leaving money on the table. They're saying this is for you, and if you use it correctly, it can turbocharge everything else in your financial life. So it is really important. There can be thousands and thousands and thousands of dollars of benefits within your compensation package, and we really are only just touching the surface today. So I highly recommend going through, looking at whatever you're offered by Microsoft. And if you have questions on it, if you're not sure if you're maxing it out, reach out to me, reach out to someone at the Milestone team. I'd be happy to talk to you. And with that, are there any final questions before we wrap up today's session?
I have nothing on my end, Kyle. Anything on yours?
Nope. So with that, if anyone has any final questions, if anyone would like to reach out to us, feel free to send me an email. My email is kyle@milestonefinancialplanning.com. As Garrett mentioned at the beginning, you can connect with me on LinkedIn. I'd be happy to chat there as well. If anyone has any questions after the fact, just reach out to us. Happy to help however we can. With that, I hope everyone enjoyed today's session and enjoy the rest of your day.